Live from New York City this morning. Good morning, good morning. 3-month lows on the equity market and trying to bounce. Your S&P 500 up 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, surging bond yields shaping up global markets. President Biden joining striking auto workers as Congress struggles to keep the government open. We begin with the big issue, consumer confidence taking hits.
We're starting to see the consumer certainly under some pressure.
Weakness in the consumer.
Consumers are going to be facing some headwinds here.
The market doesn't like the strong economy keeping interest rates higher for longer.
Even, 50 basis points higher from here really will start to impact the consumer.
Consumers continue to complain about inflation being elevated.
Higher oil prices.
They're still concerned about the labor market and their personal finances ahead.
The trend in yields is up.
Yields are rising.
You have to ask the question, is this last move up in yields the signal that we're end of cycle?
You always have that kind of last kind of move where people throw in the towel, and I think that's what we're going through.
I think from here the consumer slows.
There's a real spending issue coming up, and I think that that's going to impact earnings.
Bond yields being higher, a Fed that's higher for longer is going to continuously put pressure on just the broader markets.
The risk for the fourth quarter is, can the consumer continue to surprise on the upside?
Consumers are getting it right and saying, look, there's trouble ahead.
Let's build on that conversation. Joining us now is Canaccord's Tony Dwyer, BlackRock's Tony DeSpirito. I'll be using full names for the next 20 minutes. Don't worry, gents. Tony Dwyer, first to you. Let's talk about that consumer. Do you see this bond market move as a reflection of unexpected resilience of the consumer, or are they ultimately going to be a source of fragility?
I don't think it has very much to do with that at all. I think we're trying to make a great academic study, John, on whether it's inflation or economic growth. We lost our biggest buyers, right? Our three biggest buyers are the Fed, commercial banks, and foreign entities. So the peak day for the S&P 500, I believe, the peak moment was when Janet Yellen announced that the Treasury Department was going to increase their issuance of treasuries to fund the government. That's when bond yields started moving higher. That was the peak day for the market. Now what's happened is you've got this incredible increase in supply because you went through the period of the debt ceiling debacle. So you have this incredible level of supply. The Fed is in quantitative tightening, so they're not buying. You've got China and Japan supporting their own currencies, so they're not really buying. And then the commercial banks are under regulatory scrutiny because of the Silicon Valley Bank issue. So when you lose your three biggest buyers and you increase the supply way more than expected, guess what it yields to, John? Higher yields.
You get some
juicy yields. I don't think it has a lot to do at all with economic activity.
A 10-year at 450. A 30-year at 463, a 2-year at north of 5%. Tony DeSpirito, why buy stocks when I can buy that in the bond market?
Yeah, well, look, without a doubt, we're seeing more competition for flows from bonds. But I think, we've kind of been spoiled by, I'll call it the post-global financial crisis period, where equity returns post the GFC until the Fed started raising rates in 2021 was over 17% per year. That's more than double the historical average, and with less volatility. I think we're going to go back to the world before the global financial crisis when we had kind of 8% returns. And so one of the things we do is we look at an equity risk premium. It's effectively comparing stocks versus bonds. And when you look at that ratio is like spot on, exactly in line with historical averages. So I think we've got to get that post-financial crisis period out of our mind and look back and say, you know what? Stocks versus bonds, much more like what we've seen historically. And of course, historically, equities have won, depending on the time horizon you use, 75% of the time versus bonds. So I still think equities for the long run for your portfolio. I do think we're going to need to be more selective because of more volatility and more stock price dispersion going forward.
And Tony DeSpirito, just to pick up on that point, are you basically saying we're going back to what you might call the old normal?
Exactly.
What do you think the relationship will be like with that in mind between equities and bonds? Because at the moment, bonds down, stocks down, and then all of a sudden bonds up, stocks up. Do you think we can break that and break back to that traditional, more intuitive relationship between stocks and bonds?
I do think we're going to go back to those more historic relationships. And I think also volatility. This is really important. Volatility and dispersion will increase going forward. I think that's both in terms of earnings volatility as well as when I look at valuations. There's a wide dispersion in valuations. I look at that and say, look, two things, two conclusions for investors. One is beta is not going to be enough, right? You're going to want more than stock market returns. You're going to want to seek alpha. And the environment is ripe for still skilled stock picking, and I use that word carefully, skilled stock picking. So if you can find a skilled stock picker, I think the alpha available from skilled stock pickers is going to be higher over the next 5, 10 years than it's been over the last 10.
Tony Dwyer, do you agree with those two conclusions?
It's going to be a really difficult time, John. You're in the situation where somehow that Wall Street's thinking that you've got a historically levered system. Debt to GDP is at a generational high. And somehow we're going to have the fastest rate hike cycle in history. And it's all going to be okay, and we're going to have the Goldilocks. So our belief is that, believe it or not, when bad news becomes bad news, to the other Tony's point, that's when you want to look at taking advantage of the opportunity where the weakness has already been engaged. The average NYSE stock is now down literally 30.0% from its 52-week high. So, to believe that now the data is getting squishy, so you should become more negative because interest rates are higher, that's been in the restaurant stocks, the retail stocks, the bank stocks. It's been in all of those areas, and it's been kind of made invisible by the Fantastic Seven or whatever, phrase you want to use today. So our view is that you get three parts of this cycle, John. You get good news is bad news because it means a tighter Fed. That was 2022. Then you get bad news is good news because it means the Fed's done and rates can stabilize. But ultimately, the real time to buy, the time to be aggressive is when bad news becomes bad news. And I think we're starting to see the beginning of that with some of the consumer data. And God forbid we have a traditional credit cycle instead of a credit disaster. We've had, to Tony's point, 13 years of an incredible fixed income environment. And levering it up that way, just meaning the higher yields are going to have a bigger impact. It doesn't have to be a crisis. It's just a credit cycle, and that's what ends up in a recession.
You mentioned that economic data. Let's talk about it. Let's cross over to Mike McKee. Morning, Mike.
Morning, John. I wish I could help Tony Dwyer out, but unfortunately I've got good news, which is good news, and that's all I got this morning because durable goods is the only number out, and it does come in stronger than expected, in some ways more strong than even expected, because durable goods orders were expected to drop on Boeing, but they didn't. 0.2% gain, 0.4 ex-transportation. And the capital goods ex-defense, ex-aircraft up 0.9%. That's the proxy for business spending in GDP, so that's really good news. Capital goods shipments tell you kind of what went into the current quarter GDP, and that was up strong as well. We won't get those numbers until the end of October, if we get those numbers. Tomorrow we get GDP figures, but they're the third and final release for the second quarter, and we get jobless claims. Income and spending on Friday is going to be the last big number that we may get, as the Fed is looking at the PCE component of that. What is inflation doing? And are consumers still spending as they were? Michigan sentiment, you were talking about consumer confidence at the top of the hour. Conference Board was down some this past month, so we'll see if Michigan mirrors that. But then we're kind of out of business, because if the government shuts down, there's a lot of stuff that won't happen. I'm only going a week out at this point because we don't know how long it's going to last. But here's what you wouldn't get next week. You wouldn't get most or any of the government numbers. ISM manufacturing and services still out. That'll be important. Vehicle sales will tell us something, but really the numbers that the Fed's going to want to see are not going to be available. The problem only gets worse if the shutdown happens and goes on, but we're going to have to wait on that to see.
Mike, any conclusions on the damage it would inflict on this economy? That's the data we will and won't get. What about the damage it could do to the U.S. economy?
Well, it's not going to do great long-term macro damage. It will do damage in the short run, particularly to those people who aren't paid and have to call their credit card company and say, I'm not getting paid, so I can't pay you. And there will be some lost business. People won't go out to dinner, et cetera. But usually, the law says everybody who is furloughed gets paid when this is over. So what you'll see is a slight decline in GDP, maybe 0.2% a week, according to Bloomberg Economics, and then it all pretty much comes back once this is settled and people get paid. But there will be a little damage, not a whole lot. I guess the real question is, what does it do to Wall Street confidence?
True, true. Mike McKee, thank you, sir. Just lining things up for you, the potential that maybe we won't get some of those data points. Tony Dwyer, let's just build on some of the stuff that Mike was talking about. Let's make a list. Later this year, we could be seeing a government shutdown, student loan repayments. We've got crude back in the 90s, headwinds again for the consumer. You mentioned consumer discretionary. Given the moves we've seen recently, Tony Dwyer, is that a buy for you then?
No, it's not yet a buy until the only thing that will create a real significant and sustainable fundamental buy that brings me back to the perma bull status, John, is when you get a real drop, not a one-time drop, but a real drop, not just in U.S. Treasuries yields, but also mortgage and corporate yields. The corporate yield for the high-yield debt yield towards my Bloomberg terminal, as of last night's close, is almost 9%. It's 8.86%. So companies don't really care about what the spread is. They care about what rate they're going to be able to get money at. And until the cost of that money comes down in the Treasury, mortgage, and corporate market, we're not going to get fundamentally bullish. And just one last thing, John, to Mike's point about the data, if you look at the revision in the prior months of the core durable goods data, you kind of shake your head and wonder why you look at any of this stuff. The way that they're collecting the data and the revisions that are taking place make it very difficult for a data-dependent Fed to be right.
True, true. And when I talk about consumer discretionary, I think it's worth pointing out the kind of names that are in that group, that bucket on the S&P 500. Massive range of names. Cruise lines, Amazon, Tesla, Nike, Ford. Tony DeSpirito, with that in mind, do you like what you see, given the correction we've had so far?
Yeah, so I think one of the things to do is say, look, I'm not in the business of predicting a recession or not. What I'm in the business of doing is picking stocks. And so the way to go about this is say, what sectors or industries have already discounted a recession versus which ones haven't? And so I would call out banks and financials. On one hand, if you look at the way banks and industrials, if you look at the way banks are trading, low double-digit PEs, 10 times current earnings, low price to tangible book. They're discounting a recession. And then you look at industrials, I understand the recent strength in the data, but they're trading at multiples closer to 18, 20 times. They're both cyclical businesses. So I'll just go with the ones where the pain's already discounting, and therefore that creates a margin of safety. I think that's the stock picking strategy that you need to pursue in this kind of market.
Tony and Tony, stick with us. We'll keep building on this. Tony Dwyer, Tony DeSpirito. Your equity market right now on the S&P 500, still positive, trying to bounce by about 0.4% after an ugly, brutal day of losses again in yesterday's session. Let's get you some movers going into the open. Here's Abby.
Indeed, John, a bit of a relief rally, at least right now in the pre-market. Starting out with one stock that's not helping, though, shares of Costco. They are down, and this despite beating in the recent quarter, down 1.7%. Investors are concerned that the company did not talk about raising their membership fee. That's seen, according to Morgan Stanley, as a slight disappointment weighing on the stock. ExxonMobil up more than 1% with oil WTI crude back above $92 per barrel. Since June, this stock up nearly 20% with the crude oil rally, and clearly the best sector over that time period, as well as we've seen so much weakness for other sectors with yields higher. Coinbase Global, we have a bit of a rally for Bitcoin, John, up for the second time in just, I believe, 7 days, taking many of these stocks with it. It's an interesting barometer, of course, of risk on, risk off. If you recall, in 2021, the VIX was seen as broken, so people looked to Bitcoin today. A bit risk on for that.
Abby, thank you.
Barometer.
Abby, we'll catch up with you around the open and bow. Coming up, President Biden joining the picket line with striking auto workers.
The fact of the matter is that you guys, the UAW, you saved the automobile industry back in 2008 and before. Made a lot of sacrifices. Stick with it, because you deserve the significant raise you need and other benefits.
Team coverage down in Washington. Up next.
You guys, the UAW, you saved the automobile industry back in 2008 and before. Made a lot of sacrifices, gave up a lot, and the companies were in trouble. But now they're doing incredibly well. And guess what? You should be doing incredibly well, too. Stick with it, because you deserve the significant raise you need and other benefits.
Amazing to see President Biden joining the UAW picket line, endorsing the union's push for higher pay. This is Republican presidential candidate Donald Trump counter-programs tonight's GOP debate, visiting Detroit to speak at a non-union auto parts plant. His campaign saying he will deliver a primetime speech before current and former union members. Previously, Trump has pushed back against Biden's union agenda, saying, quote, Biden had no intention of going to visit the United Auto Workers until I announced I would be heading to Michigan. Tell him to leave the car industry alone. Your team coverage starts right now with Bloomberg's Anne-Marie. Katie Lyons down in Washington, D.C. AMH, quite a scene for the President of the United States.
It was quite a scene, and we should note the White House will say that the president is not only the most pro-labor union president we've seen in American history, but now he is proving it by showing up to that picket line, taking that megaphone, and saying, yes, you deserve the raise increases you're asking for, which, by the way, the union was asking for 40%. Now they've actually lessened that to 36%. But, Jonathan, what the White House will also tell you is that Sean Fain, the UAW president, invited President Biden, and that is why he is there. It is not that he is chasing Trump's tail there, and Trump will be there this evening. And the politics of all this has to go with the 2024 election. Michigan is crucial for the Democrats. Biden picked it up in 2020, but Trump flipped this state red. It was blue since the it was red. It hasn't been red since the late 1980s. And Jonathan, he won it by 10,704 votes. These are the voters that both these men are trying to take a hold of for next year.
They're the fine margins that you just talked about, AMH. Katie Lyons, where does this leave Donald Trump today?
Well, it leaves him wanting to, as Anne-Marie said, also address these people, these working class individuals, many of them who are auto workers. Now, as you pointed out, John, he isn't here at the invitation of the union, which is why he is speaking at a non-union shop this evening. Sean Fain, the president of the UAW, has pretty much openly expressed displeasure with Donald Trump. He said just recently he doesn't think Trump cares about the working class people. He thinks he cares about the billionaire class. And he goes on to say he's just trying to pander to people and say what they want to hear, and it's a shame. So there's a clear split between Trump and union leadership, even if he may be speaking to some union members this evening with this message that the EV push that President Biden has underway is hurting people working in the U.S. and shifting jobs overseas. All that said, as much as Trump is trying to address workers this evening, he also is trying to counter-program the second primary debate that is happening out in California this evening. That's where 7 other presidential candidates will be, probably having to address the elephant very much not in the room. What is interesting, though, John, is Asa Hutchinson, the former Arkansas governor who did not qualify for the second debate, is going to be counter-programming Trump's counter-programming. He's also going to be in Detroit this evening holding a press conference, and what his campaign says is he's going to be highlighting Trump's false promises to blue-collar and union workers in Michigan and across America. So there's going to be a lot of split screens this evening, John.
A fascinating 24 hours ahead. Katie Lyons, thank you. AMH to you as well, down in Washington. Tony DeSpirito, straight to you, sir. GM for the best part of a decade. That stock, dead money. Ford for the best part of a decade. That stock, dead money. Are these names investable, Tony, from your standpoint? Tony DeSpirito?
Yeah, so I'll comment upon the auto companies generally. Look, it's actually, forget the stock prices, look at the earnings power. The earnings power of these businesses has done quite nicely. Despite the flat stock prices. And so to me, I actually see some opportunity there, particularly when you run any kind of sum of the parts math, take any kind of investments, in overseas businesses, U.S. business, their auto finance business, add that up. And these businesses are trading at substantial discounts, right? There's a lot of fear over wages and whatnot, but even when you take that into account, I think there's a lot of opportunity in the auto sector.
And Tony Dwyer, your take?
Well, until rates go down, I don't think you're going to get enough of an increase in demand to surprise to the upside in earnings, as Tony mentioned. That the earnings are up, but the earnings power is there, but stocks are flat. So it's going to take something different. And I think for this, as well as all consumer space, I think you're going to need a much lower interest rate environment that increases. Remember, John, that when we go into recession, the market bottoms during the recession, not because the data is great, but because the lower interest rate environment improves the outlook for money. You know it's going to get better when interest rates are significantly and sustainably lower. You really need that to kickstart the consumer space, whether it's autos or other areas.
Tony Dwyer, you know the sequence of events. You throw up bond yields, they start to hit equity markets. The pressure builds on some of those corporations to do something about margins because revenue's not so great. Where's the margin expansion going to come from? Tony Dwyer, at names that may have to confront 40% wage increases in certain parts of their labor.
That's been one of my issues, John, is that S&P operating earnings are seeing a double-digit or near double-digit margin. It never was a double-digit margin prior to 2019. So the point for us is that margins see a little bit of pressure when costs go up, but the real dropper for margins, the real margin pressure, comes with lower demand, and that lower demand takes place with higher interest rates that increase the default rate assumptions and really just the cost of labor, cost of energy, all of those things. When you drop revenue, you can't cut costs fast enough. And I think we're about to embark on that period. So our mandate right now, as you know, has been light and tight. Little extra cash, more defensive posture, looking with the average stock in the NYSE down 30%, John. I'm not looking to get negative here. The time for that was last year. We're looking to stay out of the way and to attack as prices come down when bad news becomes bad news.
Tony DeSpirito, I've got about 30 seconds left on the clock. Final word, please.
Yeah, so I go back to this concept of where the pain's already discounted versus where it's not. And Tony Dwyer said that, most companies are down 30% from their peaks. I think that's really substantial. And so I'll go back to the auto example you gave. Yeah, are earnings under pressure from wages? Yes. Do rising rates mean we won't see higher vehicle sales? Yes. But what's the earnings ratio today? The PE ratio is 5 times current earnings. You don't need any good news to like these stocks. You just collect cash flow and you'll do quite well. And I think that's what to look out for. Buy quality businesses at good prices and you'll be fine in this market.
Tony DeSpirito, thank you, sir, for your take. Tony Dwyer, to you as well. Tony, your equity market on the S&P positive by 0.4%. The open and bell about 7 minutes away. Coming up in the morning calls and later, RBC's Amy Wu Silverman joins us around that open and bell with her thoughts on why tech exuberance is waning. That conversation just around the corner. 3-month lows on the S&P 500, just a little bit of a bounce on the S&P up by 0.4%. That's the price action. Here's some morning calls. First up, TD Cowen initiating coverage of Levi Strauss with an outperform rating, seeing the company well positioned to grow direct-to-consumer engagement. HSBC upgrading DocuSign to hold, seeing the company making progress in stabilizing revenue. And finally, Gordon Haskett downgrading Burlington Stores to hold from buy, 137 price target, citing links to the company's Q4 same-store sales growth view. Coming up on this program, we'll turn to tech with RBC's Amy Wu Silverman. That conversation is coming up next. High-end conversation about Travis Kelce in the commercial break that you don't need. Believe me. Your equity market futures bouncing by 0.3% on the S&P 500. On the Nasdaq up by about 0.25. 3-month lows on the S&P, the lowest since June 7th. We're trying to bounce. Let's your opening bounce, switch on the board and get to the bond market. Bonds taking a bite out of this equity market worldwide. Yields on a 10-year. Cycle highs over the last couple of days. 451, pulling back a couple of basis points this morning. In the FX market, the dollar strength sticks. The euro weaker, 105.31. On euro dollar, negative 0.4%. The dollar at the strongest point of the year so far. Dollar yen pushing 150, 149.20, and crude. Even with the dollar strength, commodities breaking out 92.38. Crude right now up by more than 2 percentage points. That's the cross-asset price action. Your opening bell about 30 seconds behind us. Your equity market open looks like this on the S&P, up by 0.3%. On the Nasdaq, up by 0.4%. One stock to watch at the open is Paramount, the company in focus after the Screenwriters Union approved a new contract with the studios and ended their strike. Other Hollywood-tied stocks, including Warner Brothers, Disney, Netflix, also taking center stage. Abby has more. Hey, Abby.
Hey, John. Well, at 12:01 LA time today. The 5-month dispute, bitter battle between the Writers Guild and the big entertainment companies. It ended as the Writers Guild, screenwriters, did approve a deal. Now, they got the 3 big demands that they wanted. First, they got a pay boost. They also have a piece of the action for some of the streaming shows that do especially well. Second, shows will have appropriate staffing level. And third, they've received a reassurance that AI will not be replacing their jobs. Now, the stocks are up modestly this morning. I think, John, what folks, investors are really waiting for is the possibility that this deal could suggest that the SAG strike, this, of course, is the first time in more than 60 years that both of these entertainment unions had gone on strike together, that it will be resolved. And that could really help out Warner Brothers and Paramount in particular. Since the strikes, these 2 strikes have started, roughly Paramount down 50%, Warner Brothers down about 20%. So an overhang could be removed. And right now, we do actually have a pretty decent rally, up more than 1% for most of these stocks.
A decent pop there. Abby, thank you. Early days, about 2 minutes into the session. Let's turn to EVs. Rivian gaining after Baird analysts named the company, quote, a bullish fresh pick. We see Q3 deliveries as a near-term catalyst and expect sentiment to improve. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. It's been a short-lived open for Rivian, now basically flat, having been as high as 1.8% following the market open. Yesterday, the stock jumped by the most amount a month after that RBC note. What they're focused on is quarterly production and delivery figures. You'll remember that Rivian recently raised guidance by a modest 2,000 units to say they will produce 52,000 electric vehicles this year across their 2 consumer brands and the delivery van that they build for Amazon. But there's always been a debate about how conservatively Rivian's been playing this. You'll remember, John, that I reported in March that Rivian had told staff that its manufacturing blueprint, its plans, showed that they were capable of building 62,000 EVs this year, 10,000 more than they're currently guiding. So the question, I guess, is how much further above guidance they're going to go. This is an EV name, pure play, that is kind of not in the same category as the other startups that have struggled. But remember that they have a plant in Illinois that is capable of building 3 times what their current guidance is. There are questions about demand, but recent commentary from executives, the CFO and CEO at investor conferences has been quite bullish about the demand that's out there, particularly bearing in mind that the two consumer brands carry a premium price point. This stock's up 22% year to date, John.
Pretty muted price action this morning so far. Ed, thank you in the first 3 minutes of the session. Let's shift to retail. Costco fluctuating despite an earnings beat. The big box giant staying silent on the timing of its increase in membership fees. Simone Foxman on this story. Hey, Simone.
Hey, John. Yeah, Costco pointing now a little bit higher after some post-market losses after these earnings came out yesterday. There's a bit of a mixed bag here. Earnings per share beat analyst expectations, coming in at $4.86, but comp sales coming in a little bit weaker than anticipated, especially when you include the impact of currency and gas. Overall, we're looking at 1.1%. The street had been looking for about 1.8%, especially seeing a little bit more weakness in the United States. The company's saying it's seeing those customers trade down. Big ticket items purchases still weak, so a lot of the interest there on the lower margin stuff, the food and that sort of thing. Shrink, however, not a big issue for Costco. Markets have been focusing, and maybe we're focusing yesterday as we saw some of those post-market losses, on what was not being said. The company did not talk about a fee hike. That is something that some analysts wanted, but people in the store is encouraging traffic growth more than double what Wall Street had anticipated, and the number of paying cardholders coming in at 71 million. Again, that's up almost 8% from a year ago. Re those fee hikes, the CFO saying it's a question of when, not if. Surely markets would like that to be sooner, but we're already looking at shares up 21% year to date, John.
The hot dog is still $1.50. Am I right? Is it still $1.50?
You know, I haven't been to a Costco and bought a hot dog recently.
Okay, that's a big deal at Costco. Anyway, Simone, thank you. Thank you very much. Let's stick with Costco. Cowen raising its price target on the stock to $680 from $600. Analyst Oliver Chen saying this: we believe Costco is well positioned to continue delivering robust earnings growth over the near to medium term, driven by square footage growth, membership revenue growth, and industry-leading comps growth on strong physical and digital momentum. That stock is up by about 0.1%. I want to turn to entertainment. AMC expanding its screening of Taylor Swift's concert film to more than 100 countries beginning October 13th. Katie Greifeld has this. Hey, Katie.
Hey, John. Yeah, great news. If you can't catch it in North America, like you said, about 100 other countries will also screen Taylor Swift's Eras Tour moving beginning October 13th. I'm sure I'll see you there. Now, tickets for the international locations, they went on sale yesterday, and prices vary by country. And this is a big deal for AMC. Remember, when this movie about the tour was announced last month, it was met with record-breaking demand. It actually, in the first day, saw $26 million in ticket revenue, and that is the highest advanced sales revenue in AMC's 103-year history. And AMC, it needs some good news. Remember, the company announced plans to sell up to 40 million shares earlier this month after getting those court approvals. That has shares down 37% this month alone, and not a single analyst tracked by Bloomberg has a buy rating on the stock. But the Taylor Swift movie coming soon.
You're not going to see me there, Katie.
I don't know.
Just for the record, you're not.
She's the voice of a generation, John.
It's not going to. Okay, Katie, thank you. Thank you. Katie's going to be there, basically, is what you're hearing there, based on that delivery. Katie, thank you. Let's turn to the bank. Serious story. Not that that wasn't a serious story before I start getting hate mail about Taylor Swift. Bloomberg learning that the U.S. Justice Department is stepping up its probe of Credit Suisse and UBS over suspected sanction breaches. Shonali Basak has the latest. Hey, Shonali.
John, when you look at what is happening now, you have the Department of Justice going to UBS officials and saying that there are these suspected violations when it comes to Russian clients over at the Credit Suisse wealth manager. Now, this is a classic problem. When you buy somebody's house, you don't know always what's in it. The UBS CEO Sergio Armati has moved very quickly through the summer to resolve a lot of outstanding investigations when it came to Credit Suisse, amounting to fines in the billions of dollars. We're talking about fines tied to Archegos, fines tied to pre-2008 RMBS matters. So coming into this new era of a potential new investigation that is still in its early stages leads to an overhang for Sergio Armati that is quite unwelcome. Now, we don't know the scope of what this could cost them in the longer term, but remember, as we've been saying, this is in the early stages of an investigation, and it ties back to a larger issue that the Department of Justice has privately voiced. According to Bloomberg's Hugo Miller and Ava Benny Morrison, this is a frustration at seeing Switzerland not doing enough to enforce sanctions when it comes to Russian individuals in this era. So we have a larger issue at play, and UBS is certainly caught up in it.
Shonali, just help me understand this a little bit more. Are these failures at Credit Suisse, which ultimately UBS inherits, or is UBS in the firing line as well for things they've done previously before this acquisition even closed?
It's a little bit of both. According to our reporting over at Bloomberg, it's largely Credit Suisse. You have to remember, UBS apparently, according to my own sources as well, has known that there could be issues in the wealth manager when it comes to their clients. They didn't know the extent of what all those issues would be. And UBS itself, they are looking at UBS. Remember, this initially started as a sweeping kind of a set of requests to a larger set of banks. UBS is definitely being looked at as well, but largely these issues are tied to Credit Suisse.
So, Shonali, as far as I understood, Sergio Armati and UBS gave up that state guarantee for legal fees that they agreed to several months back in the spring when this deal was basically explained to us all. Shonali, why did they do that? Did they not have a decent understanding of where this might be going?
Yeah, they did not. And that it was part of the problem. Remember how quickly this deal came together, John? There was a very implicit understanding. I also will have to say that for all of these companies that are pushing so heavily into wealth management, this is the ugly side of wealth management. And it is something that Sergio Armati, Colm Kelleher, they know that this could be an issue moving forward. They did not know the extent of the issues. And again, this is another thing that they could face as an overhang for months ahead.
Our chief Wall Street correspondent, Shonali Basak, breaking that down for you. About 9 or 10 minutes into the session, that stock, of course, trading over in Swiss trading. But here in the United States, we're down by about 3% or so. I want to turn back to tech. Amy Wu Silverman of RBC Capital Markets noting a decline in, quote, tech exuberance, writing this: when we dig into what the options market is pricing for mega cap tech, it is mostly that bullish sentiment has waned. Amy Wu Silverman joins us right now, I'm pleased to say. Amy, you were warning about higher volatility. Here it is. Is there more to come?
Here it is indeed. And yes, unfortunately, I think there is also more to come. Look, even if we strip out everything that's going on, John, UAW, debt ceiling, geopolitics, it's just seasonally a very strong month for volatility in October, going back 20 years. this is typically a time when you see volatility picking up. And unfortunately, we have a lot of muddle through catalysts to go through, which suggests to me that we're still going to get that bid in volatility.
Got all these headline risks on the horizon, including the shutdown. Is that something you're focused on at all, Amy?
Yeah, unfortunately, I wish I didn't have to. I feel like we watch this movie again and again and again. And we kind of have to just go through it. But I just want to remind folks that, in 2011, this was an issue that brought the VIX to 45. I don't think we're going to get there, but the problem is because there is historical precedent for some of these spike type events, you just can't ignore it. You have to muddle through with it. And hopefully it's something that we can just digest. But until we actually do digest it, the market certainly has to price that into its volatility surface.
Amy, Mike McKee was on the program a little bit earlier this hour, and he was talking about the data points we might not get if the government does shut down. Does that, do you think, put even more emphasis on the bank earnings we get later in October, in the middle of next month?
It certainly does. And the other thing I think it does is it's going to change what we seasonally expect in the later months of the year. So just as October of the last 2 decades is a time where volatility picks up, usually we get a decline in volatility in November, December. But if we're going to push forward these data points and you're going to get them all at once later in the year, unfortunately, I think the market has to brace itself for even a higher VIX in those later months as well, John.
With that in mind, what are you advocating for with clients at the moment? What are you suggesting they should do?
Look, this has been a struggle for, I'd say, at least the last 2 years, where put skew has been underperforming and hedges haven't really been doing well. I think the major difference now is if you look from 2 months ago to now, folks have jumped in the pool, so to speak. There's much more participation in areas like mega cap tech or just overall in the market than there was before. And so, look, you have something to hedge, and those hedging levels have been extremely low this whole time. And I know that's sort of a boring thing to talk about, but at least there are events now to catalyze that low volatility where I think that didn't exist in the summer.
What have they been hedging, Amy, when you think about it? I know you've picked out, let's say, Apple and the bearish sentiment around that name. Is that about rates in the bond market? Is that about China? What is that about?
Yeah, so it's interesting. In Apple in particular, this is a name where if you look at mega cap tech, if you look at that Magnificent Seven, most of what we're seeing in option sentiment is just a decline in exuberance. So folks just aren't that bullish anymore. Whereas in Apple specifically, you are seeing hedging. You've seen that even with the 10% move down in Apple. I think that's very China related. But I also think it's the fact that, again, you had that massive move in participation. And now because you have that length, that's continuing to be there as you get data points in China. The other areas we're seeing are stratified. So you're seeing hedging in Canada, for example, and you're seeing hedging at other parts of the market like the credit-related ETFs, but it's all stratified hedging, John. It's nothing where I can say the full-on market level SPY, IWM, they're seeing a lot of pickup in demand there.
I think we can all appreciate how frustrating it is to talk about the potential for a government shutdown. Amy, appreciate the update. Amy Silverman there of RBC on the potential for a shutdown and everything else going on at the moment, looking for higher volatility. About 14 minutes into the session, equities up here by 0.25% on the S&P, on the Nasdaq bouncing back by just 0.5%. Coming up, we'll talk about it. Lawmakers scrambling to avoid a shutdown.
We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Team coverage coming up next.
We'll be bringing up 4 of the appropriation bills we've been trying to do since July. Finally, we got the members together to be able to make that happen. If we're able to finish those 4 along with the ones we already, that would make it 73% of all the discretionary funds that we're supposed to appropriate for this time. We will move a continuing resolution, bring a rule to the floor to secure our border and keep government open.
Speaker McCarthy fighting for his party's votes as the House and Senate charge ahead with rival spending bills. The U.S. still on track for a government shutdown at the end of the week, despite incremental progress. President Biden playing the blame game, saying, quote, funding for the government is just a basic responsibility. It's time for Republicans in the House of Representatives to start doing their job. Economic fallout of the potential shutdown expected to grow the longer it lasts, impacting everything from federal salaries to GDP to the next Fed decision. Let's get your team coverage. Bloomberg's AMH in Washington. And Ira Jersey. Anne-Marie, where is this one going?
Well, Jonathan, as you said, it's incremental steps at the moment, baby steps to potentially keep the government open. But the track that they're on, it does look very likely that the government will be shut down come October 1st. So you have two different issues at play here. One is the Senate side, and they are putting forward their own stopgap funding bill. I call it very vanilla in terms of what's in it. Keeps the government open just 6 days before Thanksgiving, so through November. And it does come with some Ukraine aid and some disaster relief aid. The issue is Speaker McCarthy can't put that on the floor because those hard right members of his party, like Matt Gaetz, already says that there'll be a motion to vacate, a.k.a. fire him. So what Kevin McCarthy is trying to do on the House side is show goodwill to some members of his party. They were able to get through late last night just getting bills on the floor to debate. That's something he wasn't able to do last week. And he says once that's through, these are full year spending bills. Once that's through, they'll look at a continuing resolution, a stopgap measure. But it comes with deep cuts in discretionary domestic spending, as well as immigration provisions that the Democrats will not sign up for. So then there's potentially this third option, Jonathan. It's called a discharge petition. And what you could see is some Republican moderates signing up with Democrats basically over Speaker McCarthy's head, taking control of the floor and voting through pretty much a clean stopgap measure. The issue is, Jonathan, this has happened only twice in this century. So it's anyone's guess on how this gets done this weekend.
Fun and games is always a mess. Ira Jersey, whenever I try and talk to people about this at the moment in the market, they just shake it off. They don't want to talk about it at all. Ira, what can we take away from this that means something to what you do every day?
Well, I think there'll be some volatility, and presumably one of the outcomes of this will be slightly slower growth in government spending over the next 4 or 5 years. And that ultimately might be modestly good for the Treasury market, because one of the things that's pushed Treasury yields so much higher of late is the idea that and the fact that we're getting larger deficits than the market was originally thinking. So there is a potential positive outcome for Treasuries in this whole mess, but at the same time it's very uncertain, and clearly volatility in markets might pick up a little bit. Something important to note, though, John, is that this is not like the debt limit issue that we had back at early June. We're not talking about defaulting on the debt. We're not talking about Treasuries not being issued. The Bureau of Public Debt remains open. The Federal Reserve remains open, and we will continue to roll over debt and issue new debt as well. So that is a whole thing is off the table.
Anne-Marie, final word on the GOP debate a little bit later. Is this going to be a feature of that conversation, fiscal austerity?
Oh, absolutely. Fiscal austerity, and also what these individual candidates would do in terms of their advice for their Republican Party in the House especially. And, Jonathan, we've seen a wide spectrum of that. We know from reporting that Governor DeSantis has been calling some of them, saying, yeah, maybe potentially shut the government down. The former president, Donald Trump, who won't be there, he'll be doing his own counter program, which we spoke about earlier, in Michigan, he said, hold the line, shut it down if you don't get everything you want. And then there's going to be others like Governor Nikki Haley, which says we have to keep the government open, but we need to also make sure they're doing their jobs in terms of fiscal health for this country.
The Fox Business hosting that one a little bit later. Want to watch. AMH, thank you. Alongside Ira Jersey there on this bond market. Your equity market, better than yesterday, that's for sure. So far, at least. Let's see if this sticks. About 22 minutes into the session, we're positive here by 0.3%. Let's get you some sector price action. Here's Abby.
And John, based on the bearish action we've had recently, that's just the second up day in 7, but let's see if these gains hold. And sector-wise, it suggests that maybe that could happen. The composition is not so shabby. Energy, the best sector, up 1.3%. We also have communication services, real estate, tech up there. Utilities and staples and healthcare are among the down sectors. Actually, healthcare just flipping slightly positive. Those are defensive, so the fact that they're down, in a way, that's risk on. Over the last 3 months, though, John, and of course we are coming close to the quarter end, most sectors are down. Energy up with oil. Communication services also higher. But take a look at those rate sensitive sectors. With yields going higher, those dividends look less well. Those sectors are worse, even down more than technology.
Abby, thanks for that. Your update up next, the calendar for the week ahead, your trading diary, just around the corner. 25 minutes into the session, stocks higher across the board here. Outperformance on the Russell, the small caps, the S&P up by 0.3%. That's the price action. Let's get to the trading diary. The week ahead looks like this. Donald Trump speaking to current and former UAW members at 8 p.m. Eastern as the second 2024 GOP presidential debate kicks off at 9 p.m. Thursday, the Fed speak, picking up with Chairman Powell, Goolsbee, Cook and Barkin. Plus, we get US GDP and another round of jobless claims. And finally, the government shutdown deadline coming at midnight Saturday. I'm sure you can't wait for that. About 26 minutes into the session, your equity market just about positive by 0.3%. Thank you very much for choosing Bloomberg TV. Good to be back in a seat. Thank you very much for all the feedback over the last week as well. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.